If you have money sitting in a savings account right now, and you're counting on interest rates staying where they are, there's something happening inside the Federal Reserve that you really need to understand. Before we get into this, a quick and important note. Nothing in this video is financial advice. I'm not your financial advisor, and I don't know your personal situation. What I am going to do is walk you through what's happening in the broader economy, break down the mechanics in plain language, and give you the context you need to have a more informed conversation with someone who does know your situation. Always do your own research and always consult a qualified professional before making any financial decisions. Hey everyone, welcome back. I'm Bernard Ortega, and if you've been following this channel for a while, you know that I try to do one thing differently from a lot of finance content out there. I don't try to scare you. I don't try to sell you something. I try to sit down with you and actually explain what's going on, the way a knowledgeable friend would, not the way a headline would. And today's topic is one I've been getting questions about for months. People keep asking me about the Fed, about interest rates, about whether their savings are safe, and whether the environment we've been living in for the past couple of years is about to change in a serious way. So today we're going to talk about something called a liquidity trap. What it is, why some economists believe the Fed may be walking into one right now, and what it could realistically mean for everyday savers like you and me. This isn't doom and gloom. This is just something worth understanding. So let's get into it. To understand where we are, you have to understand where we've been. For most of the decade following the 2008 financial crisis, interest rates in the United States sat at or near zero. The Federal Reserve kept them there deliberately as a way of encouraging borrowing, stimulating spending, and keeping the economy moving after one of the worst financial shocks in modern history. For savers, that era was genuinely painful. You could park money in a high-yield savings account and earn almost nothing. Certificates of deposit paid fractions of a percent. Bonds were barely worth the paper they were printed on, figuratively speaking. The message from the Fed, whether they said it out loud or not, was simple. Don't save, spend, and invest. Then inflation hit, and hit hard. Coming out of the pandemic, a combination of supply chain disruptions, massive government stimulus, and a surge in consumer demand pushed inflation to levels most Americans had never experienced in their adult lives. The Fed responded the way it always does when inflation runs hot. It raised interest rates aggressively. Between 2022 and 2023, the Fed raised rates at a pace that hadn't been seen in decades. And for the first time in a long time, savers started to see real returns. High-yield savings accounts were suddenly paying 4, 5, even close to 6% in some cases. CDs became attractive again. Money market accounts were actually worth considering. It felt, for a lot of people, like a long overdue correction. But here's where things get complicated. And this is really the heart of what I want to talk to you about today. When the Fed raises interest rates to fight inflation, it's essentially making borrowing more expensive across the entire economy. That affects individuals with mortgages and car loans. It affects businesses trying to expand. And critically, it affects the federal government itself, which carries an enormous amount of debt. As rates rise, the cost of servicing that debt, just paying the interest on what's already been borrowed, goes up significantly. And the U.S. government has been borrowing at a pace that makes this a real and growing pressure point. At the same time, higher rates cool economic activity. That's the point. But cooling economic activity also means slower growth, potential layoffs, reduced tax revenues, and eventually pressure on the Fed to start cutting rates again to prevent a recession. So the Fed is always navigating this tension. Fight inflation on one side, avoid tanking the economy on the other. It's a tightrope walk, and it always has been. A liquidity trap is what some economists describe as a situation where that tightrope essentially disappears. Here's what it means in plain terms. A liquidity trap occurs when interest rates are already so low, or when conditions in the economy are such that cutting rates further has almost no stimulative effect. People and businesses are already holding on to cash. They're not spending or investing, not because credit is too expensive, but because confidence is low, uncertainty is high, or debt levels are already so elevated that taking on more simply doesn't make sense. In that environment, the Fed's primary tool, adjusting interest rates, loses much of its power. You can make money cheap, but you can't force anyone to borrow it. You can push rates towards zero, but you can't push them meaningfully below zero, at least not without creating a whole new set of problems. The concern that a number of economists have raised recently is that the United States may be approaching conditions that could make a liquidity trap more likely or more severe the next time one arrives. The reasoning goes something like this. We've just come off a period of historically high rates. The Fed has signaled it wants to bring rates down as inflation cools. But the economy is showing mixed signals. Some areas are still relatively strong, while others, particularly interest rate sensitive sectors like housing, are clearly under strain. Meanwhile, the federal debt has reached levels that make the government itself sensitive to rate changes in a way it simply wasn't 20 or 30 years ago. If the Fed cuts rates too quickly, it risks reigniting inflation. If it cuts too slowly, it risks tipping the economy into a downturn that then forces it to cut aggressively anyway, potentially back toward zero. And if rates do return to near zero, savers are right back where they were in 2015, earning almost nothing on money they've worked hard to set aside. Now, I want to be careful here because I don't think it serves you to present this as inevitable. It isn't. There are economists who believe the Fed has more room to maneuver than the pessimists suggest. There are genuine arguments that inflation is structurally stickier this cycle, which means rates may stay higher for longer than past patterns would suggest. And there are policy tools beyond interest rates, fiscal policy, for instance, that can play a role in managing economic conditions. This is a nuanced picture, and anyone who tells you they know exactly how it plays out is not being straight with you. What I think is worth taking seriously is the underlying dynamic. The environment of relatively high yields that savers have enjoyed for the past 2 years or so is not guaranteed to continue. It may last a while longer. It may not. And the broader question, what happens to your savings in a world where rates are once again very low, is worth thinking about now, while you still have options and time to plan, rather than after the fact. So what does this mean practically? A few things come to mind, and again, none of this is personal financial advice. It's more like a framework for the conversations you should be having. If you've been taking advantage of high-yield savings accounts or short-term CDs, understand that those rates are tied to the Fed's current policy stance. They are not permanent. If and when the Fed cuts rates substantially, those yields will fall, sometimes quickly. That doesn't mean they're a bad place to park money right now. It just means you shouldn't build a 5-year financial strategy around the assumption that today's rates will still be there in 5 years. This is also a reasonable time to think about the structure of your savings more broadly. Short-term, liquid savings serve a different purpose than long-term retirement savings, which in turn serve a different purpose than money you're setting aside for a specific near-term goal. Each of those buckets responds differently to interest rate changes, and understanding that distinction can help you make more thoughtful decisions about where your money lives. And if you're someone who's been sitting on the fence about locking in longer-term rates, maybe through a longer CD or a bond ladder, it's at least worth a conversation with a professional. Not because rates are definitely going to fall, but because if they do, locking in today's rates now rather than later has a clear logic to it. That's a decision that depends entirely on your timeline, your risk tolerance, and your broader financial picture, which is why you need someone who knows all of those things. Finally, and this is something I think gets lost in a lot of finance content, don't let the complexity of this push you into paralysis. The Federal Reserve, monetary policy, liquidity traps. This is dense material. It can feel abstract and distant from your actual life. But it isn't. It connects directly to what your savings account pays, what your mortgage costs, how stable your job market is likely to be, and how much purchasing power your money holds over time. Understanding even the broad outlines of how this works puts you in a meaningfully better position than most people. The Fed is navigating one of the more complicated economic environments in recent memory, and while the outcome isn't written yet, the dynamics at play are real, and they matter for anyone trying to save money, build a financial cushion, or simply understand why things feel a little uncertain right now. I hope this gave you a clearer picture of what's happening and why people are talking about it. If you found it useful, share it with someone who might benefit, not because I need the views, but because financial literacy genuinely matters, and most people don't get nearly enough of it. I'm Bernard Ortega. Take care of yourselves, keep asking good questions, and I'll see you in the next one.